Welcome back to Smart Money. The topic today is financial independence and whether you can achieve financial independence at an early age. We've set an age of 40. Of course, it looks unrealistic, but the moot point is if you start early, you can benefit from the power of compounding. Mrin Agarwal has been sitting with us. We also have Dilshad of Dilzer Consultants telling us how to prep for your retirement, to sit with a hefty corpus. Mrin, I want to understand, how should people with different salary brackets plan their investment? And you've given us a very interesting table as well. I'm going to get that up for our viewers on the screen. No, this is the balancing risk and returns. The salary bracket is the one that I'm actually talking about, where there are different salary brackets between the age of 25, 30 and 35. So if this is your annual income, say for example 10 lakhs, 15 or 30 lakhs, then these are the kind of investments that you need to make per month in order to get a retirement corpus of around 3 to 6 crores, by the time you are 40. Now, Mrin, just take us through this, right? This is a case study that you've done. What are the investment tools that you need to get into to achieve these numbers?
Actually, yes, this table was basically to show you that if you are planning to retire at 40, what is it that you need to do? It's a little difficult, honestly, because what is very important is to look at, for example, if you are 30 today, and what's your net income post-tax, of course, and we've assumed certain expenses based on loans and, of course, your expenses. And so if you look at it, the person is saving around 47,000 per month, whereas the amount to be invested is around 2 lakhs because the retirement corpus is in the range of about 4 crores and odd, right? Of course, we've also taken into account the fact that the person would have EPF that's already there. So keeping that in mind, those are the sort of numbers that we are really looking at. And it's not an easy thing to really do this. I mean, there is always going to be a gap between your saving and between what you're really expected to save. So I think, also going back to the previous table that I had shared, that it is very important in this case to actually invest aggressively in equities. So normally what happens is that people tend to be very conservative. They tend to just stick on to the employee provident fund or safer investment that's giving you a fixed return, but do not consider equity investments for retirement, or even if the equity investment is considered, it's considered in a very, very low allocation. And that's where the previous table, which I had shown, that if you're investing at 6% versus if you're investing at 10%, what the difference in corpus can be between 1.15 to 1.9 crores, right? So and this I do put a lot of emphasis on using these calculators, because see, not everybody has a financial advisor. While ideally you should be working with a financial planner on your retirement plan, but if you do not have access to a financial planner, then the first step really is to figure out how much to save. And it's only then you can figure out whether you can actually retire at 40. The second part of it is to invest aggressively. And I see the other table that's up as well. As we see in India, the allocation to equity is in the range of about 5 to 10%. So with that sort of an allocation, your overall portfolio is generating you a very low return, which is not beating inflation. And it's only with a higher allocation to equity can you actually look at even beating inflation in the first place. So figuring out the number based on your income, of course, and your expenses, and investing aggressively in equities would be what I would recommend for DIY investors.
So this table is also very interesting, balancing risk and return, right? So what Mrin is trying to tell us, I just want to get that table up. If you put only 5% of your money in equities and the rest in maybe FD and insurance, the rate of return that you're getting is less than 6%. But if you get more aggressive in equities, right, look at portfolio C, 50% in equities, your rate of return goes up all the way to almost 9%. So this is, of course, Finsafe India's views, and it depends on what kind of equity you're investing in. But the moot point is equities will give you a higher return, right? So tell us about the different investment tools, Mrin. If you invest in, say, equities compared to, say, EPF, of course, your EPF, PPF bracketed together. Then there's the debt market investment as well. Have you done any kind of analysis on, in the longer term, what would sort of help you generate better returns?
Well, again, while we employee provident fund and you have PPF as well, and then you have a whole lot of debt funds. You also have the NPS, corporate bond, and the government bond categories. Now, typically, when you look at the returns over 10 years or 5 to 10 years, you see that the debt funds have given you anywhere in the range of about 5 to 7%. And the NPS returns have been slightly higher. And I guess that's really to do with the fact that it's very low cost. So if you see NPS returns have been about 1.5% higher. But again, this is not a recommendation to, choose a NPS over a debt fund. You need to do your research correctly. Now, when we look at the equity options, I think there are only two options. One is equity funds and the other is NPS. I do not recommend stocks because I don't believe that most individuals can really figure out what stocks to hold for the long term. And of course, I do not recommend the investment-linked insurance plans because they really do not yield you returns that can beat inflation. So what you're left with is then equity mutual funds and a whole variety of equity mutual funds. And of course, you have the NPS active equity option as well. I do recommend NPS for people who find it very difficult to figure out which fund to buy when, do I hold it till my retirement? And for people who are very confused about all of this, I think NPS is a great product because you just have to invest. They're going to take care about where to invest. And the money is logged in till the age of 60. So that also makes you very disciplined.
Sure.
The only thing that you have to keep in mind with NPS is that at the age of 60, only 60% of the money comes tax-free and 40% gets invested into an annuity. So you need to be fine with that because annuity is going to be taxable as well. So I think the trade-off between equity fund and NPS is really, do I want the regular pension? Or do I want more flexibility where I choose the investments, I choose the funds, and I have the ability to exit when I want to?
Okay, I'm glad you brought out this topic about, the EPF and the different kind of investment tools because we have a financial tip of the week for our viewers. Here are 5 reasons why the Public Provident Fund or PPF is a good investment tool. So let's tell you a little bit about that. The Public Provident Fund is completely safe as it is backed by the Government of India. So that's one reason to invest. It's a low-risk investment with guaranteed returns. It is a tax-saving tool because the amount invested, the interest earned and the overall maturity amount are all tax-free. After saving for 3 years in a PPF account, you can also avail a loan against your invested amount. So that's another reason. And finally, you can start investing in a PPF account with a minimum of 500 to about maximum of 1.5 lakhs a year. So you don't need to have a lump sum amount to have a PPF account. So that's just a financial health tip of the week. And we thought, we'll just bring it to our viewers since this is a financial literacy show. But finally then, I just want to get a comment from you, Mrin. Some queries coming in on since investing in index funds is highly advised these days. Can you give us 2 or 3 index funds that one can look at?
Well, I like the ICICI Nifty Index Fund and the UTI Nifty Index Fund, both being Nifty 50 funds. I also like the ICICI Next 50 Index Fund. And I think on the mid-cap 150, one can look at Motilal Oswal.
Okay, that was pretty quick. Thanks a lot to both of you, Mrin and Dilshad, for joining us on this special episode of Smart Money where we talk about financial independence. With that, it is a wrap on this edition. Thanks a lot for watching.